Hello and welcome to UAN Governmental Fund Accounting Course 103. In this video we're covering debt and projects in Chapter 3 of 3. Additional chapters in this series are budget changes and budget and cash management. Let's begin. A new debt that wasn't planned at the beginning of the year must be incorporated into the budget's two separate components. Of course, by new debt, I mean a new loan of money from a source such as a bank, the OPWC, the OWDA, EPA, or another institution that's offering government entities loans. These financial institutions often do not distribute money to the government directly so you can spend. They require you to request payments to be made directly to the contractors and engineers and other vendors as the projects move forward. So the money doesn't actually go in and out of your bank account. However, the financial records of a government entity must contain the money you had the use of, as well as the cash you spend. So your budget components need to reflect what the governing board has authorized, and the annual financial reports have to show the complete financial picture. So this is where the new fiscal officers fall off the wall in fund accounting. They didn't have to deposit a check. It wasn't direct deposited. They didn't have to issue a purchase order or write a check to the vendor because the money didn't flow through their hands. But the thing is, the fiscal officer and the governing board did have to act like this was real money going in and out of their bookkeeping. They did have to incorporate the revenue into their amended certificate. They really did need to appropriate the money, issue purchase orders, and post receipts and payments through their books. So the use of the money appears properly on the annual financial report. In addition, many governing boards don't understand that there's a limit to the debt they can enter into, and they must look at this first. The debt ceiling refers to the amount of indebtedness that the entity is limited to by law. The limitation is measured by the entity's total tax valuation of the properties listed on the general tax list in duplicates. When a government entity is considering entering into debt, they need to know if they're within their debt ceiling. A call to your county auditor will help determine how your county handles the certification that the intended loan is within your debt ceiling. The process varies among counties, so you need to understand your county processes. Do you need to send a letter requesting certification? Can you fax, mail, or hand deliver the letter? And how soon will you receive a response? Once the governing board knows that they're within the debt ceiling, they and the fiscal officer have a lot more work to do. For example, consider the fund or funds that will repay the loan. If you're using restricted money, is it permitted to be used for the purpose of debt repayment? Check your levy language. Do you need a capital project fund to receive and spend the loan? Will you also then need a debt retirement fund for the loan repayment? Or is it going to be paid directly from an existing fund? Loan repayments are never made from the original capital project fund. These are two separate subjects. One, the receiving and spending of loan money, and two, debt repayment. Call local government services if you aren't certain how to set this up in your system. Consider the cash flow of the fund to be used for the loan repayment. How will the debt payments affect the cash flow within operation expenses until that loan is paid in full? Will you cause a cash crisis in the fund before the loan has been fully repaid, as we saw in our earlier example in monitoring cash flow? And then finally, when all of these factors have been considered, the board adopts legislation authorizing the loan, and this is only the beginning. Now the fiscal officer can request an amended certificate for the new debt revenue and enter the supplemental revenue budget. You'll probably need to add a new revenue code to your account structure, and again, you would call local government services if you're not certain which revenue account to add. Upon receipt of the amended certificate, the governing board must adopt supplemental appropriation legislation to authorize the expenditure of the loan. And then the fiscal officer enters a supplemental appropriation budget. The fiscal officer issues the purchase order to the vendor for the full purchase price, and you make sure the loan repayment schedule is understood and properly planned. Review all of these steps with the governing board when they are considering a loan. Remember that even when your loan institution is directly distributing the loan money to the vendor, you have to post the items through your books. I already told you how to set up the budget components and issue the purchase order to the vendor. Now it's time to actually post the items. Issue a receipt for the loan money. You would use a standard receipt unless the bank charged you a fee. This sometimes happens. For example, if you're borrowing $35,000, but the bank only distributes or gives you $34,501 because they charged you a fee of $499 off the top. The fee will require a purchase order to the bank from an appropriation account for this type of contractual agreement. If the bank charged a fee, you can use a memo receipt to post the full $35,000 loan as revenue and the $499 as bank fees for the net deposit of $34,501. You would also issue the payment. If the bank distributed the loan money directly to the vendor, you post an electronic payment to print a voucher rather than a check. If the bank distributed the loan but you are also making a cash contribution, you will prepare a warrant to the vendor for your cash contribution. Both the electronic payment representing the bank's portion and the warrant representing your portion will post against the same purchase order for the full purchase price. The last step in handling new debt is to prepare for the repayment. You must understand that the posting of the debt revenue as a receipt and the purchase as a payment are completely separate from the paying off of the loan. These items would never be posted to the same appropriation accounts. Debt payments must always be posted to the correct fund's debt program and object codes for principal and interest. When you enter into debt, you should be provided with an amortization schedule, a schedule of principal and interest payments and the dates they're due until the loan is repaid. Review the amortization schedule to determine when the first and continuing debt payments must be made. Sometimes the first debt payment will not be posted until the next fiscal year, and sometimes the payments will begin in the current fiscal year, requiring changes to the current year appropriations. The repayment of the debt should be budgeted and paid from funds authorized to make debt payments, and must be in accordance with the laws that govern the entity's funds and debt agreements. So if the first year payment is due within the current year, the board must adopt supplemental appropriation legislation or reallocation of current appropriation legislation to the principal and interest appropriation accounts. If the first payment isn't due until next year, use your amortization schedule to determine the amount of principal and interest that will be paid during the year and include these amounts in your new year appropriations. Keep in mind that if a payment is due before permanent appropriations will be adopted, you must include the principal and interest payments in the temporary appropriations. Our last section in this chapter is how to incorporate a new capital project into your current year. This is going to take some planning to incorporate the project into your budget and cash flow. Let's take a look at the separate issues that must be considered to plan a project from beginning to end. When incorporating a new project into the operating budget, you must incorporate the project into and manage both components of the budget: resources available certified on the amended certificate and board adopted appropriations, even if the money is being distributed directly from a grant or loan to the vendor. You must incorporate it into your budget. Consider the cash flow. Grant applications may outline the project at an early stage with initial cost estimates, and then the plans and figures are changed as grant awards and rejections and bids are received. Understand how the grants and loans are to be distributed and the order they can be used. The exact matching local share and loan amounts may not be known until those final bids are awarded. As the project progresses, change orders approved by the board may also require additional local cash or loan money to be added to the project, requiring changes to the resources available, your amended certificate, and the board adopted appropriations, requiring legislation. The project remains fluid until all final decisions are made, and it's really challenging to keep both the budget components and the cash up to date with the required changes. There are many different types of loans and grants, and when you have multiple sources of funding that are contributing to a project, you have to understand all the sources and how they will distribute their portion. Each source of revenue has to be considered alone and in conjunction with other sources of revenue. Some funding is going to run through your bank account, and others are going to be distributed directly to the vendor from the grant or loan provider. So although they are all part of one project, you will have different types, as different as the fruit you see on the screen. They're all fruit, but they're not identical. Some examples of types of funding are reimbursing. This type repays after project completion. That means you have to advance the cash for spending, and then the grant will repay you at the end of the project. Secondary. Specific order of funding access, so you may have to spend your local cash or other sources of money before you can use a particular source. You need to know the order the funding will operate within your project. And then there are the projects where all the money is accessed simultaneously. It's spent in conjunction with all other funding as the project proceeds. So when the contractor submits a bill for $10,000, it's approved by everybody, and the amount is divided between the funding sources. For example, 50% is the grant, 30% is the loan, and 20% will be your matching cash. Each funding source provides a portion toward each approved payment request. So you can see how a project can be very different. You need to understand each funding source and how it's going to flow into the project. If you ignore these details and only consider they're all revenue, you're going to run into trouble. These items can't be crammed into one piece of fruit. They are individual revenue sources with individual requirements. Make sure you understand each one and how it's going to flow into your project. In order to fully explain how to handle a new project, we're going to have to present a sample. Now remember, this is just a sample. None of your projects are ever going to be exactly like this one. Now remember, the book is going to cover a little more detail. You may want to take a look at this chapter for some more information. First, we have to consider the project cost. Here is our estimate of all the development we're considering, with a total cost of $176,000. We also need to review the sources of revenue that are going to support the project. We have two grants. Our local match is made up of a loan and cash. All sources of revenue total $176,000. So we know we have enough revenue to support the project, but this is just the figures from our planning. We have more work to do. Next, the project must be incorporated into the two components of the operating budget. Always refer to the current chart of accounts and discuss your project with local government services to use the correct fund, revenue, and appropriation accounts. In this case, we would be setting up a brand new capital project fund, and we would be requesting an amended certificate for all the revenue that will come into the fund. Our amended certificate would show we started the year with a zero balance and have $176,000 of estimated revenue in the other sources column, giving us this full amount as resources available. On the screen, I've shown the sample revenue account names as they might be entered into our revenue budgets. Once we receive the amended certificate, the governing board can adopt supplemental appropriations. Notice how the entire project is budgeted to only one account. You don't require separate account codes based on sources of revenue. Many fiscal officers confuse this issue. Don't try to separate your appropriations by revenue. That gets very confusing. Use the correct appropriation accounts for the expenditure purpose, capital outlay. Purchase orders will separate the cost by vendor, and it will be smarter and easier to track your pay requests and distributions of different sources of funding in your filing cabinet than in your appropriations. Once the project is incorporated into both portions of the budget, you will issue purchase orders to each vendor as contracts are signed. Before moving forward with the project, the governing board and fiscal officer has to understand the cash flow of the sources of revenue. And I don't want to rain on our park development project, but we really need to consider and get the cash flow in place before you walk off into the sunset. But don't get discouraged. These projects are very difficult, and I need you to fully understand the cash flow with the different types of funding. Our local match money needs to be transferred from the general fund. Remember, we opened a brand new capital project fund, and it is anticipating receiving transfer-in revenue, but the legislation has to be in place. This is going to require an unencumbered appropriation in the general fund transfer-out account, and the governing board has to adopt legislation to authorize the interfund transfer. If you have reimbursing grants, you have to provide the cash to do this portion of the project. Then once you document you've completed the portion, the grant reimburses. They send you the grant, and only then can the advance be paid back. So the board has to adopt legislation to make the initial advance. Once the grant reimbursement takes place, they also adopt legislation authorizing the advance repayment. Change orders. Change orders made to the project that are approved by our funding sources often require changes to the entire budget structure. We may decide to expand the project a bit and contribute more cash. That would require more interfund transfer out appropriations and additional interfund transfer legislation, along with a new amended certificate for the transfer in revenue and supplemental appropriations in the capital project fund. The same kind of changes would take place if the bank agreed to loan us additional money. Additional legislation approving the additional loan, you'd have to check your debt ceiling first, and then still an amended certificate to certify the additional revenue, followed by supplemental appropriations to spend the additional money. You can see that change orders in large projects are very common, and they can be very complex when they increase the cost of the project. The last discussion point for the project is how the portion of the funding not distributed through your bank account is posted through your financial records. The fiscal officer must understand the method of communication when grant or loan money is dispersed directly to the vendors. Many options are used. Confirmations by mail or email, or you may have access to an online portal to see approved payments. The fiscal officer is responsible for making sure that these direct distributions are posted to the financial records in a timely manner. Remember, we already have our purchase orders posted to the vendors when the contracts were signed. And then as the project payments requests are approved and sent to the vendors, the fiscal officer will post receipts for each source of revenue that will be directly distributed to the vendors. This is often referred to as a memo entry, meaning it's a memo into and out of the entity's financial records because the cash didn't go through the bank accounts. However, it's not a memo type receipt in the UAN software. Do not confuse the terms. A UAN memo receipt must have the same vendor for the source of money and the payment of the fees, such as the county auditor tax distributions. It is not appropriate to use a UAN memo receipt to post these project memo entries through your financial records. In our example, a standard receipt is posted for the grant money, and then payments are posted to the vendors. You post an electronic payment to the vendor to represent the distribution of grant money directly to the vendor, and you would prepare a warrant to spend actual cash for your cash portion of a pay request. When posting memo entries through your books, be careful that your receipts are equal to your electronic payments. Let me show you what that means. Pay request number 1 is submitted to our project grant number 1 for $10,000. $2,000 of that is the engineer and $8,000 the contractor. When the pay request is completed and submitted to the grant, the fiscal officer knows to be ready for that approval. Once the pay request is approved and distributed directly to the vendors, our engineer and contractor, the fiscal officer posts the transactions through the capital project fund. A standard receipt for the full amount of the grant, $10,000, is posted. And then I post an electronic payment to the vendors. I'm posting a $2,000 electronic payment to my engineer and an $8,000 electronic payment to the contractor. The memo entries must exactly offset the receipt. So I have $10,000 in grant that was approved and $10,000 in electronic payments distributing that amount of the grant. Make sure you stay on top of your memo entry postings. Each time a pay request is submitted, be aware you're going to be required to make the posting when it is approved. The local portion of cash would require you to prepare a warrant for the vendors for your local share of any pay requests. And everyone involved in the project should understand the significance of change orders and how they affect the funding and the two separate components of the budget. And again, the book contains some more detailed information about our sample project. You should read through the material for more information about incorporating new projects into your operating budget. In this chapter, you learned about the debt ceiling and incorporating new debt into both components of the operating budget, budgeting the loan repayment to principal and interest accounts, new projects and how they're incorporated into the budget components, and how directly distributed project funding is posted through your books as memo entries. This concludes Fund Accounting 103, Chapter 3.